All right, guys, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. New records for stocks, new questions on how to play this post-rate cut market. Joining me for the hour today, hopefully with some answers, Joe Terranova, Jenny Harrington, Steve Weiss. We will check the markets. We do have another record high for the Dow. A little bit of work to do elsewhere. NASDAQ and the S&P up about 0.25% each. As you see, Goldman's Tony Pasquarello today, choppy, but Weiss, the trend is still higher. That's what he says. The setup's demanding. The path will be choppy, but it's a bull market, and the primary trend is still higher. Give me your thoughts. Do they match up with Mr. Pasquarello?
They match up perfectly. You know, you got to feel a little unease, though, at how easy it's been to make money in the market. It's not supposed to be this easy, and how much the market has really rallied. You didn't even have a correction. I mean, you had a correction arguably in semis, arguably in big cap tech, but I'd hardly call that a correction when those stocks are up anywhere from 50 to 150 to 200%. So it's troubling, but yet I see nothing really getting in the way. Now, there are potential for blips, like if the port strikes that are going to happen in the East Coast and the Gulf Coast, but you're going to keep the West Coast open. People may have inflation concerns, but I don't think that's going to be an extended thing. I think it actually can get settled before the strike. So the point is that you never know what's going to hit the market, but I do think you do have to keep some cash because it's just unnatural for it to be this easy, for it to keep going up day after day.
Does it matter how many cuts we get and when? Because if the market obviously has its own expectations. Goolsbee today talked about seeing, quote, many more. The Fed must stay ahead of the labor market weakness, he said rates need to drop, quote, significantly. Kashkari was a bit more measured. He talked about a slower pace. We do get PCE on Friday. Now we're going to be sort of listening to everything they say and trying to figure out what the actual pace and size is going to be.
Many more? No, I disagree with that. I don't think the market needs many more. That implies some form of significant economic contraction. I don't think that's where the market is at all. I look forward to the earnings season. I think that's the potential catalyst from where we sit right now. And to go back to where we began the show is where do you want to be? I think it's critical that the viewers understand that a lot of the places that have been working so far are the places they're going to work as we move forward. Stay with the large caps. I keep emphasizing the small cap trade. I have been trading the Russell futures from the short side since the announcement of the Fed meeting. If the Russell was going to rally, post-Federal Reserve, it got its 50 basis points. That is the moment. So I know we have a couple of charts. If we could show them, let's look at what the Russell, the IWM, has actually done since Wednesday.
Not great.
It's right back to where it was before the announcement. What else are we waiting for with the Russell? This is exactly what the Russell wanted. It wanted its 50 basis points in a good economic environment.
You know what we're waiting for? Confirmation or greater belief that we're going to have a soft landing. Rate cuts don't matter unless the economy has its actual soft landing. Why would you buy small cap stocks, many of which are in the financial space, by the way, if you are not fully on board with the idea that the Fed's going to be able to pull this off?
Wait, hold on. First of all, large cap financials are performing well. The overwhelming sector largest weighting in small caps is healthcare. Now, you're saying you're going to wait for the soft landing. Everyone's telling me the soft landing is here. The soft landing is already here. So I need more evidence. I need more data. I need to see the unemployment rate to go perfectly below 4%.
No, everyone's not telling you that. Who's everyone? I mean, even Goolsbee, who is as dovish sounding as you can possibly be, was talking about the labor market weakening. There still are significant enough concerns that they're going to pull this off.
Scott,
so you're not going to put 2 feet in the pool.
It's weakening from a historic level. It's not weakening from a 4.5% unemployment rate. It's weakening from a historic level. And yes, I keep hearing from all the investment banks, from the analyst communities that we're in the midst of a soft landing. Look, the point is very simple. Throw up, if you can, a chart of the QQQ, because I keep hearing from everyone, you want to make this rotation out of large caps into small caps. Look at what the QQQ has done since the Fed announcement. That's when the rotation should have began. When you got the 50 basis points, we should be talking about a Russell that's up 2.5% from Wednesday, not flat from Wednesday, while the QQQ is the one up 2.5%.
Jenny, what's your take? Citi talks about at the index level.
Yeah.
Right? We're talking about, that's exactly what we're talking about here, that it's going to be tougher 6,100 is their bull case. Their base case is 5,600 for year-end 2024. 5,600, below where we are now.
Great. So this is where I disagree with Joe, where you were saying the rotation should have started when we got the cut. And so, Scott, I totally agree with that city remark, that at the index level, it's going to be tougher. Outside of the index and to the first point too, we're still in a bull market. And so what I see it just differently than you, where I see it this quarter, we have small cap up 10%, mid cap up 8%, Dow Jones like dividend index up 12%, S&P up 4%, right? Tech down 0.11.
Utilities up 17.5,
Right.
real estate up 16.5, and
Yeah.
financials up 10.5.
And so what I see is a ton of that expectation was pulled forward up until the rate cut.
Right.
And then everyone just took a pause, right? Fine, fair enough. Whenever you have, and this goes to your point, it shouldn't be so easy to make money. Fine, we made a ton of money in those sectors up until the cut. Now we're just pausing. But here's the thing. I think you think it's over from there. I think it's a pause. And what I think we need from here on, because we know we're in a soft landing, right? No one's questioning that. We've been in a soft landing for a long time. It looks like we're going to be in a soft landing for a long time after this. What we need now is earnings. So for the next 2 weeks, there's no catalyst to keep it going. All of that, those huge returns quarter to date were pulled forward. Now we sit here and
you
twiddle
get
our
some
thumbs.
data. You get buybacks and things hanging. JP Morgan's trading desk, by the way, says we're bullish, inclined to buy every dip. They want to stay tactically bullish. The macro setup is supportive of the rally into year end. They also agree choppiness is likely, but aren't they right?
We're all right. It is still a bull market, right? A lot of growth was pulled forward. Things have faded. I think choppiness, buy dips in individual stocks when you get them. I mean, you always buy dip. That's always a smart move. But I think it sounds so lame, but I think everyone's kind of right here. It's a bull market. It's going to trade off on leadership. We've already seen that. I think that continues, but we really, really need earnings to keep the utilities, to
Joe's
keep the small
point,
cap.
though, is well taken, though, that the Russell, you had a lot of people come on the network, have conversations with me leading up to the cut, suggesting, hey, you can't buy the Russell until you get the cut. Now you got the cut, and people aren't buying the Russell. It's true.
Okay, so now you got the cut, but the Russell, what's it up year to date right now?
Can I give you 3 words?
Yes.
Sell the news.
The
So
Russell's
the
up,
Russell
the Russell's up 9.5% year to date.
The Russell anticipated the news that was announced on Wednesday afternoon. And to me, it was a classic sell the news moment. I will be the first person to step in and to go buy small caps if I see the type of price action that's suggesting that you do exactly that. But to me, you're talking about the quarter, and it's been a strong quarter for the Russell relative to the other areas of the market. To me, that was all in anticipation of what was announced on Wednesday, and what was delivered on the other side of that was a sell the news moment for the Russell.
I hear you. I just think that the valuations are still kind of mismatched. And so, again, if we go back to some of the data that we were looking at over the past quarter, where you saw earnings growth expectations sector by sector for each of the quarters, right? Large cap tech, actually, they're still growing a lot into the fourth quarter, but their earnings growth rate versus the first quarter is significantly diminished. As we go into the fourth quarter, small cap, Russell names, value names, those actually different sectors actually pick up steam into the fourth quarter. So I hear you. I think it's take a pause. I don't think it's sell the news.
So here's how I look at it. The Russell 10-year performance, okay, the Russell 2000, is just under 7%. The 10-year performance for the Qs is 19%. So why would you leave? You think it's going to catch up, but already it's ahead of what its trend line is, right? 50% ahead of its trend line. So why would you get out? If you're an investor looking for something to do and you have cash, that's one thing. But if you're mostly fully invested, why are you going to pay taxes, sell your winner, your long-term winner, and your future long-term winner to take a chance on an index that's flawed?
Well, you're not, because that's why Alphabet's on pace for its 10th straight gain.
Yep.
That'd be a new record. And Meta hit a record high again today.
Yeah.
And there are more bullish calls. So your point on that is well taken. And aren't earnings, which Joe says, and I mean, Jenny says is what it's all going to matter, earnings? Aren't earnings going to underscore why the money continues to flow to those stocks?
Yeah, but if you take a look, yes, except what if they miss? So it wasn't that long ago that Meta missed. or actually a good quarter, but their CapEx was going to go
I
up.
know. Was it really a miss? I mean,
No, it wasn't. It wasn't a miss, which is why I bought a significantly larger position at about 435, 440. Now, I've since pared it back, but that's when you have to buy them. That's why Alphabet right now is my largest position, because it's somewhat damaged merchandise. The street's really mixed on it, and people just don't look to the future and look at the asset values and what their cash flow generation is and what it could be. So I think Alphabet's one of the best. Obviously, I think it's one of the best.
these stocks are still well off their 52-week highs. Like Alphabet's
And
15%
Alphabet's
off its
below market
52-week
multiple.
high.
How else do you get that? You know, Meta is still off its 10-year multiple, despite where the stock is. So to me, those continue to be great holds. So why gamble on an index where you got to figure out, okay, what am I going to do about financials? What's in financials? 18% of 2000. Why mess with it? Just go with the proven winners, and that's what you're supposed to do, is ride your winners until they're no longer winners, and they will be perennial winners.
Meta's target today goes to 645 from 580. That's at Citi, reiterated their top internet pick.
So you're in a period right now for the Mag 7. Well, what are they trading on? We're anticipating what's going to happen with earnings. You're in a blackout period as it relates to buyback. You had on Friday Apple increasing its exposure in a various different indexes, so that lifted Apple as well. And obviously you had the product announcement. But right now, this is really a story of these stocks are trading off of momentum. And if you look at these Mag 7s, to your point, Scott, it's Meta that has the strongest momentum currently.
Crazy momentum.
And it's the one out of the Mag 7 that's actually making the new all-time high. I would actually turn the viewers towards Amazon, because I can tell you, and we own it in the ETF, so I'm not going to, unfortunately, I can't personally buy it until the other side of the rebalance at the end of October. But I could tell you, second to Meta, it's Amazon that has very strong momentum.
You know
right
what?
now.
So let me ask you a question real quick. You don't own any of these personally. Is that right?
No, I own all of them through the ETF.
You own all through ETFs. You make,
And I would buy
you
Amazon.
make a big case as to
Amazon.
why these stocks are still going to be the ones to outperform. Why don't you own any of them personally?
Amazon would be the one I buy on the other side of the rebalance.
Why the only one?
So that is the one to me that has the opportunity from a relative outperformance perspective to catch up against the other Mag 7. Because if you pull back the lens over the last 3 to 4 years, there has been a degree of underperformance. Now, the question that you're asking me is, why did I come into this moment not having any of these stocks owned personally?
Well, especially when you're making such a big case for them.
I think one of the reasons that I could point towards is that I had owned previously Microsoft and Apple. Apple, we were kind of thrown off sides with the ETF strategy, and I talked about that on air. We got out, we got back in again, and I didn't feel comfortable personally maintaining a position that was actually the opposite of what the ETF strategy was doing. So it wasn't from the perspective of I think these stocks are bad or I think these stocks are going to underperform. It was just from the perspective of I didn't like the ethical narrative of doing something that was counter to what the strategy ultimately was doing.
Sorry, go ahead.
Okay.
Let Jenny go.
Thanks. I think it's interesting because I just want to get back and use this kind of as a case study. When you said Meta, for example, right? It's on momentum. But let's think about why it's on momentum. It's on momentum. The first trigger that kind of got the momentum going was a couple years ago when they said we're going to have our year of efficiency. And they cut their costs and they started cranking out the free cash flow. People woke up. Now the momentum that's keeping it going is it's starting to be valued like an AI play. When you're not a momentum trader, when you're not a technical analyst like I am, and you're a fundamental analyst like me, here's what you see. Here's what you see on a lot of these. You see a very different construction, but now than when we started. You've got a 3% free cash flow yield on Meta, not the 5% it used to have. Now it's trading at 23 times earnings. To your point, it's gone drawn up on momentum, but I don't know how sustainable that is because we don't know if their llama model is actually more valuable than others. We don't know how much they're going to spend on AI, and we don't know if that whole year of efficiency becomes a year of huge spending and all of that earnings growth starts to fall apart. So we're looking at this, and it's a huge position in our growth.
I mean,
I don't agree with that.
Okay, well, let me just finish the thought.
I would say that all of those potential worries you have are outlier worries. I mean,
maybe, but when you had a stock that's gone from $79 2 years ago to 500 and change with this $645 price target, and none of your original investment thesis, which is that they're going to start cranking out cash, it's cheap, and they have better earnings than anyone else, and none of those are there, I say you sit back and you say, should I trim this?
Well,
Should I
I'd
still
say
own this in
I'd
this
say
way?
you're picking a moment in time. It's an isolated moment in time.
Jenny owns
when
the stock, by the
was-
way.
Yeah, it's a
When the
huge
stock
position.
was below 100, number one. Number two, different sectors, different companies have different free cash flow yields. So you can't argue that a free cash flow yield for an industrial should be the same as
I'm
for
not.
technology or bank stock. And then, I disagree that it's all momentum. Momentum
Mr.
stock price. I think it's momentum of fundamentals. If you believe in AI, you want them to deploy CapEx. You want them to spend more. I do believe in it. We get the announcement from the Middle East today about they want to build their own fabs. They believe in it. You just can't stop. It's the best adoption cycle in history. Period. End of
Okay,
line.
those are all good points. Does anybody take any pause as we're having this conversation about tech, that the semi trade, forget about Intel giving an outsized move to the space today because of deal talk from a position of perceived weakness. But you look at the other major chip stocks today, NVIDIA's lower, AMD's lower, Broadcom's lower, Taiwan Semi's
Broadcom, I don't understand.
barely a winner. They're on track for their third negative month. They're still down 16% from their July record high. Truist today downgrades the semis to neutral. They were constructive. What do we think about the semis?
It's been a brutal quarter for the semis. If you look at the SMH, I think it's Texas Instruments and Broadcom that are higher, 5% maybe for Texas Instruments, Broadcom 8% or I might have that backwards, but very few stocks in the quarter in the semis are higher. I think we're at a moment where it's kind of you've got this line in the sand that the semi industry will be defending against as you move into earnings. I think it's a very critical period because they obviously can break down further if they don't deliver the type of earnings that we have expected from them over the previous quarters. Would I be selling them right here? I probably wouldn't. Would I be selling them on the other side of earnings if they don't deliver? Yeah, I probably would.
Weiss, you were alluding to the fact that Taiwan Semi, one of your large positions, is there's chatter around that in talks with the UAE to build chip fabs.
Yeah, and it's also the cheapest stock in the semis. And in order to, I'll say it, I've said it 1,000 times. Every time Jensen Huang speaks, he says, if I can only get more capacity from Taiwan Semi. So Taiwan Semi, and the beautiful thing about their capacity out there building, like if they go to the Middle East, I don't know what the details are, but I can tell you the sovereigns are going to fund the building out of the fabs. It's not going to be Taiwan because not Taiwan Semi, but I don't understand the love affair with Broadcom. I hear so many people come on and talk about Broadcom. They've got a highly cyclical component to their business, and it's not small. They also have a commodity business. They've got some AI exposure for sure. But when you take a look at the multiple there, the multiple is higher than NVIDIA. So what are people thinking about? It doesn't have that growth.
Now
it doesn't have the technology.
It wasn't 1 year ago. It was the valuation alternative to NVIDIA.
Exactly.
And the AI component was beginning to grow. I agree with you. Where they are now you can call that
It's just
into question.
crazy to buy Broadcom.
He owns it.
I do. I own it, and I've trimmed it previously in the last several months. But I agree with you. Where we are right now you call it to question. But 1 year ago was clearly everyone's coming on air saying this is a great valuation
But also
alternative.
recently on the dip. But here's what after last quarter. But here's what I'd say: semis are naturally a commodity industry. Period. That NVIDIA's lead time on their technology is unusually long. Usually it doesn't take that long. Number one. Number two, they've got significant exposure to the industrial complex, whether it's autos or basically anything. So you've had a broadening out of where chips go, right? Versus 20 years ago, they're in everything. So I think they go as the economy goes.
My point, though, is do you need both? Do you need to control both sides of the line of scrimmage in this game for the market to continue to win? Right? You can play offense with the mega caps. Your offensive line's great. Your defensive line, you need, or vice versa. Do you need the semi trade to work? Or eventually you're going to start losing ball games because you can't control both sides of the line anymore as dominantly as you could
That's
before.
really different. I think the mega cap are also defensive. Look at their balance.
I meant the mega caps were on the defensive side. But if you don't
And
have
offensive.
if you don't have participation from the semis, At what point does it make the overall prospects of at least the NASDAQ side of the market,
One thought, Joe.
tech side of the market, weaker?
As long as you see other leadership emerge, it doesn't matter if the semis. Now, if they get completely trashed, that's one thing. But if you see other leadership pop up,
But you just
don't
called
need
you
semis.
just called into question whether we actually would do that, right? Why would you risk it in these other areas of the market? You said that yourself.
Well, there are certain other areas I would risk. So defense, aerospace defense, except for Boeing.
No, but those stocks
It's
those
a
are
small
not
group.
going to be the
It's a
ones
small group.
that get you there.
Yeah,
right?
but you can find, well, I don't know. I mean, take a look at Leidos. It's been monster performance. I mean, it's
Well, there are
double
going to be
what the market is.
idiosyncratic stories within every
Yeah.
single sector. In,
I like
in the
your
market.
point, because I don't think semis can endure another quarter of being down 9% and not have it affect the market. I also think, I keep saying this, there's people that disagree with me, but as long as we're talking about tariffs, unrestricted tariffs, the semis are going to struggle in that environment because it's going to be punitive if in fact that actually occurs for the industry itself. So again, this is a critical moment as earnings approach for the semiconductor industry, because on the other side of that, if they break down further, no, the market's not going to be immune from that breakdown.
Let's do a move before we take our first break. It has nothing to do with technology at all, but it's ADM.
Yeah.
You sold it.
I did sell it. So, look, I bought it. Yeah, I got about 10% gain in it. I bought it because they couldn't file because they had some accounting issues. So they were on hold on filing their Qs, updated filings, etc., even their K. But I figured that when that event happened, when the fraud was announced or the accounting investigation was announced, the stock was in the 80s. I thought it would bounce back there, or at least get part of the way there. It's gotten really none of the way there. So I just thought this is, again, a commodity business, different kind of commodity, and that it's not really of interest to me. And ATM has been a perennial underperformer, basically since I've been in the business a long time. So why own it? I owned it for a catalyst. It didn't matter what industry it was in, frankly, that they were in. It mattered the catalyst, and just bought it at this point. I don't see the upside.
People will tell you you want to own it because it's a single digit valuation, and that's where some of these stocks fall into a value trap. Since that news broke in January, the stock has not had any recovery whatsoever. And what's been more difficult is the commodity environment, particularly the agriculture environment. You have ag stocks that are down 20% so far year to date. So you're not going to see a recovery for the stock in that environment.
We also didn't point out, has nothing to do with this either, it's that rates are up as well, right? For most of the days since the rate cut, bring it back full
So it
circle to
is.
the way we started our conversation. So if you say, well, the benefits of the Russell and these small caps or those companies have floating rate debt, it's like the Fed cuts interest rates by 50 basis points, and actually on the shorter to, even the 10 and 30s, the rates are higher.
Yeah,
That's a great
Well,
point.
that was the disconnect I talked about going
If
into.
rates were lower, the Russell would not be acting
Right.
as it is.
And that was the disconnect I talked about, because I said the bond market is assuming there'll be 50 because it was 60, 66%. I didn't think the equity market was assuming that. I thought the equity market was more anchored at 25 bips. So as a result, you had one sell in the news, and you had the related to Joe's point, the Russell sell in the news. And by the way, it can take the 50 bips a while to go through the economy. So the jury's still out.
It wouldn't be a sell on the news if rates were
No, that's a
moving
great point.
lower.
That's a great point. That's
No, wouldn't have been.
I agree. I'm saying the bonds were selling the news, right?
Right. Well, when I was sitting there next to Gunlock, right when Powell finished,
Yeah.
and you look at the screen, and first instinct is to look what the stocks are doing, what's the reaction, and you notice that yields almost across the, half the curve were actually higher.
Yeah.
Now maybe that was on the commentary about the strong economy. I don't know.
So 6-month low for a 10-year, 359. Guess when it occurred? The day before the Fed meeting on the 17th.
All right, we'll take a quick break. When we come back, another move from Mr. Weiss to tell you about. Just trimmed one of his biggest holdings. We'll discuss next. All right, welcome back. Let's show you shares of Netflix today. Interesting note from Bernstein, which says hedge funds are poking around on the short side here, especially at $700. They do reiterate their market performance. 625 is their price target. Weiss, you're trimming it this morning.
Yeah.
What do you make of that note? Now, you're doing it because it's such a large position.
Yeah.
But what do you
I
think?
did. So if you call when the stock got hit, I really increased the position. So now it's still one of my largest positions, but it was 30% larger than any other position, which made it irresponsible to have that as from a continued risk management standpoint. I make nothing of the hedge fund news shorting it. First of all, short position is only 2%, number one. Number two, I'd love to be in the opposite side of the trade of all the portfolio short positions of the hedge funds over the last 5 years. They short because they have to. That's why they charge 2 and 20. So they look for liquid names or they do indexes. So, and having been a former hedge fund manager, that's the game. So I don't care about what their thought is. What they should watch out for is that Netflix, because if you saw the new Disney, Hulu, etc., Netflix could raise prices yet again. So
well, that's what the Bernstein analyst says. He's bullish on that, by the way.
Yeah, I mean, look, do you want to try and trade it because it's had such big momentum? You can roll the dice and do that. I wouldn't. But, the funny thing is, I went to sell it this morning, and the stock was up like $5. And while I'm trying to put together where the shares are going to come from, it's up 5, it's up 6, it's up 7, it's up 8. So finally I just said, look, this is looking a little dicey here. So I just sold it because I do think it's ahead of itself right now.
I own it personally. I agree with everything that Steve's saying. I mean, I think you've had these moments where it appears to be correcting. You've got these little palpitations in the market, and it comes back very quickly. Look, Scott, if you owned the Joe T ETF, which holds Netflix long, and you're sitting there long Netflix, and I come on air and I say, hey, I just sold Netflix, you would be bothered by that. So I'm kind of bound by the problem that I have where we're 30 days out from the rebalance. Would I be upset if someone rang the register on Netflix right here? No, I wouldn't. I really wouldn't, because I think it's run pretty strong. I know for me personally, I have a good gain in it, and I have no problem bringing the register because I think we're getting a lot of the good news that's built in.
Well, to be clear, it's still one of my largest positions. I only cut it back.
What do you do with Palantir, which is up 52%?
You stay with
since
it.
August 5th.
And it's higher today. So I know exactly. Oh, I'm sorry.
52% in 6 weeks?
I'll let you continue.
No, it's up 52% since August 5th.
Okay. And we had today the downgrade from outperform at Raymond James.
Time to move to the sidelines was the commentary.
On valuation. That's what we're citing. All right, look, if you want to move to the sidelines on this company, which is seeing significant growth in the commercial business, at least show me the evidence that the commercial business is reversing the growth and the market share gain that it's capturing. If you can see that, then yeah, you want to ring the register on Palantir. Otherwise, the stock is in the momentum sweet spot. And the momentum sweet spot is not just technical, it's fundamental. The business is pivoting from being focused on government relationships and government contracts to building out the commercial segment and utilizing AI. And they're showing you in their earnings that they're successful in that endeavor. So it's up 52%. You're correct. The S&P inclusion helped with that appreciation. But I think this stock goes back to the November of 2021 high, which is somewhere around $45. I could see the stock approaching $50 easily.
All right, I got Uber today, reiterated by Jeffries. Price target's $100. Everybody owns it, but Jenny, you go first.
Thanks. So when we bought this a couple of years ago, the thesis was that it was going to generate $2 billion of free cash flow in 24 and $4 billion in 25. Meanwhile, they're generating $7.5 billion this year. They're expected to generate $9.5 billion of free cash flow next year. So it's the kind of thing where, like, even from a fundamental perspective, you keep holding it. Who cares about the momentum? Who cares about the technicals on this one? The fundamentals are amazing. The free cash flow generation wildly exceeds anything we could ever expect. The competition's gotten less for them, which drives the business. However you cut it, it's just a positive story here.
We're like Oscar and Felix.
Wait a minute. Hold on.
The only problem I have is I hate that 39 times multiple, but when the growth is so significant, you can continue to hold it. So
Hold on a second. I'm sorry to interrupt you. Wasn't I don't know, trying to remember. Handful of months ago, you trimmed it, didn't you? Or at least you, and then you were somewhat skeptical of it when Brad Gerstner was on the day he was on.
Well, remember, okay, so we've trimmed it twice. It's still a huge position in the growth portfolio. And what Gerstner was saying then was he's basically, I can't remember the exact price target, but it was really high. And I was saying to him, how do you get there? And he said to me, you need to be a believer. And we have been. And that's why we've continued to hold it, because I couldn't get there straight on the numbers. The numbers didn't make sense, but Brad was
Sound like you were like
no, but that's
a doubting believer.
okay, I'm a cynic. You've all figured that out by now. I'm always doubting. I'm always a little cautious. It's why I manage our dividend income strategy. My partner Greg manages the growth strategy. It balances out. But I'm always cynical. I'm a cynical bull. And that's just how it is, which is why you trim a little, take a little off.
Okay.
But there's an important point here too, which is it's a little different than Meta, where on this one, the original investment thesis, which is they are going to generate enormous free cash flow, is still intact. On Meta, it's a little different now. The valuation isn't that compelling. The growth rates aren't quite as strong. So I would say, and this is purely speculative, if we look back in a year from now and one of those two positions isn't in the portfolio, it's more likely to be Meta than Uber. Still holding Meta for now.
Joe, trade desk, neutral, Moffett Nathanson today, $100 is a price target. That's down about 7% from where we are now.
Yeah, I want to give Jenny something she can appreciate other than momentum. Do you like free cash flow generation, 33% growth
I
for the
love
next
free
3
cash
years?
flow.
That's what this company is going to do. 33%
Sounds like you should be talking to Greg, though.
free cash flow generation
Okay.
over the next 3 years, $51 billion market cap. This company is in the sweet spot for ad tech, and they're perfecting on it.
Okay.
Oh, and by the way, the momentum's good.
Right. That is what Bank of America is warning about a specific sector of this market. We'll debate it next. Welcome back. Bank of America today with a note that says energy is a bear trap. Jenny, they say investors have shorted energy aggressively. Shorted energy aggressively. We believe price risks are more balanced as power demand, geopolitical risks surge in 2025. They say Brent and WTI are going to average 80 and 76 respectively. What do we think here? That's for this year, and they think those prices are going to be lower next year.
I think they're right. And I think that there's a third factor too, which is really interesting. There's this big pipeline, a 580-mile pipeline from the Permian over towards the Gulf of Mexico coming online next year too. It's called the Matterhorn pipeline. And what that's going to do is allow the producers to get even more oil out of the Permian into the places it's needed. And as many of you know, natural gas has been trading at negative prices this year. There's just so much, they're basically giving it away. Once this pipeline comes online, that stops too. So the producers are going to be a lot more profitable. U.S. is going to be increasingly dominant. In addition, there's 2 more big pipelines coming on in 26 and 27. So I think that really supports the price of oil here, the production of oil. I think it supports the energy companies. So I think it is a bear trap. You may recall I sold Exxon kind of recently, a couple months ago. And what I started doing over the weekend was reinvigorating research on Devon, which I haven't bought it yet, but it's my way of saying, in fact, I think there's a bull play here.
Okay. Let me see a little Devon in the screen.
And I'll let you know if and when I buy it. It's got a 5% yield, but they're one of the ones who would really benefit from that Matterhorn pipeline, and they're a Permian producer. That's where you want to be.
Thank you. You do own Energy Transfer, Kinder, One Oak, and Shell.
Right. And so this goes into, if you're shorting stocks in the energy space, what are you shorting? So if you've shorted Chevron, which is down 2% this year, or Schlumberger, which is down 18% this year, great job. If you have shorted the midstream space, which is where I've spent 2024, then you've really lost. You have things like Kinder reaching a new 52-week high. It's up 25%. All of our pipeline companies on the K1 producing side, Energy Transfer, Enterprise Products, they've had great years. Williams, One Oak, just really fantastic years all along. So within energy, the midstream space has held up. I think it continues to hold up next year.
Can you give me 20 seconds on this? Agree or disagree?
I think there's going to be a lot of M&A in energy over the next couple of years, and I think you want to identify where potential opportunities are.
You're happy with what you got? Diamondback, EPD, EOG, Exxon, Hess, Phillips, Valero?
Don't like the refiners. The refiners are broken down.
Okay. You'll give us more details later. Well, Mike Santoli's here, our senior markets commentator. I don't know if it's a good or bad thing that you showed up as early as you did. You had to listen to this here at the desk.
Behind the scenes.
You don't have to make any comments regarding what you heard.
Sure.
From those two. Let's just be clear.
I got to go to church.
Please. What are your thoughts here? New week, big week at PCE? Market sort of meh?
It's a big week to me to see how the market reacts to itself in the sense of making new highs. We got through the Fed. If anything, it's a quietish macro setup until we get to Friday. And I think personal income and spending within that report is pretty significant. Watching 10-year yields leak higher a little bit, I think that's probably good. I don't think after the Fed you wanted to see 10-year treasuries continue to rally and yields go down, which would suggest Fed's still at risk of making a mistake. So I think it's all to the good here. It's a little bit of a digestion that, we had the immediate reflex reaction. We're 1% above the July highs. It's really hard to go in search of something to complain about here. When you're talking about soft landing, the prevailing view, yields are going down, earnings estimates are going up. The only thing is you've rebuilt the valuation, and that's something that's slow moving. It's not something that's an immediate catalyst.
You know, we pointed it out earlier in the program. This movement in yields is hurting one of the trades that was expected to do well post-cut, that being small caps.
Yes.
And as long as yields continue to at least stay where they are, if not move higher, wouldn't you say that's a continued issue?
You know, potentially. It's funny because when treasuries were rallying and long-term yields were coming down, the line with small caps was, oh, but the Fed actually has to cut. You know, it's only when the Fed cut. It's not about the market yield. So I don't know if that's what it is. I think that, you know, they had their little spurt higher and Russell's over 2,200. I mean, I think a lot of things are okay at this point, but I wouldn't look to that to be the leaders of whatever this next move is. You're actually seeing the market find its way here when you have semi-stalled and the rest of the market able to do okay.
I threw you off course at the beginning. You didn't even get to what you really principally wanted to talk about today, was the Berkshire Hathaway
We had our
moves.
say
But
on Berkshire.
we will,
Yes.
well, we can discuss it because the good news is you're
do
back
that.
with me then.
Yes.
I'll see you in a couple hours. That's Mike Santoli. He'll be back with me, of course, on Closing Bell. Oh, we're quick. Weiss.
LDOS.
Western Union, 8% yield.
Walmart.
All right.